We have all watched some Warner Brothers content throughout the years. Most recently, the company had a dramatic change in its business structure. The stock price dropped by a massive 50+%, and at the same time, some of the best investors in the world bought in. Bearing that in mind, I'll answer if the stock is still a buy for me based on its fundamentals, how their business changed, and who bought in. Stay tuned to find out this and all other valuable information regarding the company. As always, everything said is with educational purposes and should not be taken as financial or trading advice. So let's begin. On the 8th of April 2022, the American conglomerate AT&T spun off its Warner Media business and merged with Discovery, and thus a new public company emerged called Warner Brothers Discovery. This company owns some of the biggest names in television: HBO, Discovery, CNN, Cartoon Network, Looney Tunes, and DC, the company owning Batman, Superman, Wonder Woman, and other popular superheroes. All of these characters are intellectual property of WBD stock. Warner Brothers Discovery also has Harry Potter and Game of Thrones, just to mention a few of their top IP holdings. From a streaming perspective, they own HBO Max and Discovery Plus, which are direct competitors with Netflix, Disney Plus, Amazon Prime, and Apple TV Plus. On the following chart, you can see the chart share of all top 5 streaming platforms in the Western world. What is obvious is that Netflix is massively losing market share, going from more than 30% down to close to 20%, while the biggest gainer by far is HBO in orange, doubling its market share over the last year and a half from 7 to 15%. During the summer of 2022, it was the first time that streaming represented a record-breaking 34.8% share of total television consumption in the US, exceeding cable with 34.4% and broadcast with 21.6%. But the traditional TV market is not dead, and it will still grow according to Grand View Research. The growth is projected to continue to at least 2027, and on an annual basis it is expected to stand at 3.4%. Unlike other content companies, WBD stock has a very established presence in the traditional media space. Just like Disney, this gives them a very strong competitive advantage in regard to somewhat newer players in the space like Amazon and Apple, and including Netflix. They have very well-known and well-established IP content brands which could be leveraged to gain more subscribers in the future. But nothing is certain, as always, in the finance and investment space, and we always must be cautious and vigilant for the risks. According to Global Newswire, the global streaming market will be growing on an annual basis by 19.9% until at least 2029. This makes it quite the big opportunity market, but as such, we're seeing a lot of competitors in the space, and just like Peter Thiel says in his book 0 to 1, competition is not a good thing for a strong and profitable business, as the competitors are engaging in constant pricing wars. When it comes to investors, one of Warren Buffett's regarded value investor successors, Seth Klarman, most recently during Q2 increased his position in WBD stock by 60%, and the stock is now his 6th largest position with a 5.9% portfolio share. Out of all 79 super investors whose portfolios are tracked by Dataroma, WBD stock is the 55th most owned company, as 7 out of 79 investors have stakes in it. In general, the company at the moment is a money loser. It does not generate positive net income, but the company guidance is that by 2025, they will have about a 10 to 12 billion EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. On a current market capitalization of $28 billion, this sounds pretty much amazing as it gives an EBITDA yield of 30%. But the risks are enormous as they are not only the just mentioned competitive pricing risks and lack of real earnings risk. Warner Brothers Discovery also has massive debts. The company has total liabilities of $85 billion, while its total assets are $136 billion, which comes out to an equity of $51 billion. Now, one might say, well, the company's market cap is $28 billion and we're getting an equity of $50 billion. This means we're buying the company for free and getting $23 billion as extra assets for nothing. While true from the outside, out of the $136 billion, a whopping $81 billion is in intangible assets, with 34 out of the $81 billion is placed as goodwill, which, as Charlie and Warren Buffett say, these are bullshit assets, as they cannot be sold off. In terms of their intangibles, like their content, it definitely has value. The question is exactly how much value is there. At current prices of WBD stock and the massive debts, I would like the price to fall by 30 to 40% more, as this will make the company be worth about 18 to 20 billion, and then I think for such a price, buying all the company's content IP would be a good deal, as if the price goes to these levels, there is a very big possibility that some other player in the space will just buy out the whole company, as 18 to 20 billion is nothing for most tech businesses like Apple and Amazon especially. In general, WBD stock is very interesting. It has a big possibility to be a very good investment and become profitable, but I would not like to bet on that as there is still a very high level of uncertainty. I want to buy the company when there is more fear and lower prices, and then I can pay about 70 to 80 cents for at least $1 worth of assets. With this, I end the analysis. Check out my other analysis videos on the channel, subscribe for more, and comment down below which company do you want me to check out next. Goodbye for now, and I'll see you next time.